Hi everyone, let's take a look at problem 1-4, which deals with corporate taxes. Okay, we have the Tantor Supply Inc., a company. It's a small corporation, and it is the exclusive distributor of a major line of sporting goods. For 2003, the firm earned $92,500 in taxes. And on Part A, we need to calculate the firm's tax liability using a corporate tax rate schedule given in Table 1-3, which appears right here below. Okay, let me slide up and let's bring this problem to light. Okay, now I've staged a little bit of the problem just to save us some time. Okay, up here it said that the company had $92,500 of income before taxes. So I've dropped that in here. Okay, so we need to calculate the corporate taxes. Okay, first, let's indicate what the base bracket is that we need to consider. Since their income is between $75,000 and $100,000, right above where I'm pointing, then we know the base tax is $13,750. Let's jot that in. I've already typed that in ahead of time. And the base bracket is $75,000, right? Then we need to consider what's the marginal rate above that. Okay? So the amount above the base bracket then, let me hit the F2 key to show you, would be the $92,500 less the $75,000. Okay? So we've got $17,000 above the base bracket. Now, then we need to consider the marginal rate on that, which is 34%, and we need to multiply that out. I think we do it right here. Yeah, I'll hit the F2. So we take the value in cell D34 times D35, and we come up with the tax in that 34% marginal bracket amount is $5,950. And then the ending answer to Part A then is what's the total tax liability. So the total tax liability then is $19,700, and that takes care of Part A. Okay, now I've moved back to the top of our spreadsheet so that we can read Part B, which says how much are Tanner Supply's 2003 after-tax earnings. Okay, let's slide back down. Give us a little room here. Okay. We know that the earnings before tax, I'll just reference that cell right there, is equal to the 92.5, right? And we know the total tax liability is what we have just calculated above. So we'll call this one income taxes, and that would be equal to the 19,700 we calculated. Then all we need to do is underline it, take the earnings before tax less the income tax, and we come up with earnings after tax or after-tax earnings. And you could call it either one of those. And then I'll format this just like that. And we come up with $72,800, and that's the answer to Part B. Okay, now sliding back up to the top to read what they want on Part C, which is what's the firm's average tax rate based on your findings in Part A. Let's slide back down. Okay, let's find the average. Let's type that in first. Okay, how do we find the average tax rate? We take the total taxes, okay, and divide it by the pre-tax earnings. So we'll take the $19,700 divided by the earnings before taxes or pre-tax earnings, and then turn that into a percentage. Let's just take it to one decimal point, and we come up with an average tax rate of 21.3. Okay, now back at the top again, we'll tackle Part D, which says what's the firm's marginal tax rate. Okay, well that's pretty easy. The marginal tax rate is the rate at which the last dollar is taxed, and since we fell in this $13,750 plus 34% marginal rate over $75,000, but we didn't earn more than or $100,000 or more, putting us into the 39% tax bracket, then that number to the left of my mouse is really the number, the 34%. So we'll just put in marginal tax rate and it comes from the last amount we would need to consider, our marginal rate, and that's 34%. And that's this problem, everyone. Thank you.